G'day, welcome to Lunch Money. We are the online and social media home for special situations, workouts and capital raising professionals. My name is Nick Samios. I'm the Director and Fund Manager here at Hermes Capital, and I am your Lunch Money host. We've got subscribers in the US that are well into the double digits on our podcast. So a very special hello to those of us that are watching us in the US. It's only high double digits. I like to say that we're not unpopular, we're just very niche. So thank you very much to all of our subscribers everywhere. If you're watching us live, we've got the faculty for you to pop us a question, and we'll try and get those questions to our panelists. The proverbial pet shop parrot has become an expert on the insolvency cliff. Everyone's talking about it. And so now, once again, there is talk about whether or not Australia should introduce a US-style Chapter 11, or at least adopt some Chapter 11 features. And we've got a couple of guests that are going to lead us through a discussion on whether or not we need to be doing that. And I'm going to start off with introducing Paul Apathy. G'day, Paul. How are you?
Fine. Yeah,
fantastic.
Good, thanks. How are you?
Great. Paul's a partner with Herbert Smith Freehills. He's a specialist in restructuring, turnaround, and insolvency. And what has been keeping you busy over the past week or so, Paul?
Well, it's been a pretty busy period over the last 6 months, really, with everything arising from all the disruption brought on by COVID. Over the last week, I guess I've been working on a few different restructurings, some big, some small. The one that's probably most topical for this discussion we're about to have is we're actually acting for Speedcast, which is an Australian corporation, or at least Australian headquartered corporation, which is going through a US Chapter 11 process to try and restructure its global business. That's kept us very busy for a number of months, and continues to be very interesting week to week.
That's an Australian company that operates in the US, or it's an Australian sub of a US company?
It's a company which operates globally. Really, its business is providing broadband internet to people who are in locations that are hard to reach with normal internet providers. So offshore oil rigs, cruise ships, mines, things like that. Operates all around the world, buying capacity from satellites and then selling it to these people. It's headquartered in Australia. The parent company is Australian incorporated and listed on the ASX, but it has subsidiaries incorporated in countries all around the world, and it has the majority of its business in the United States. So it's very global, and it's that sort of weight towards the United States, which is one of the reasons why the group as a whole, including the Australian incorporated entities, have filed for the Chapter 11 process.
Okay. All right. Well, you're the right guy to have on today. That's for sure. You're obviously up to your elbows in Chapter 11. So thank you very much for that. And aside from that, are there other insolvencies or M&As? What other sort of stuff crosses your desk in the meantime?
Well, my focus is restructuring. So that sort of would be the majority of the work that I'm doing currently, and that's a mixture of debtor side work, acting for my corporate clients that are going through stress and working out sort of how best to try and restructure their facilities and their finances to get through this period. And then there's the creditor side work that we do. So doing quite a lot of work for offshore funds in different situations, some big, some small, working through their situations as well.
Asian funds, or
some are based up in Asia. I'm doing one piece which is dealing with people based in London, though it's a New York headquartered group. So it's a lot of time on the phone at not particularly sociable hours.
Yeah, well, the US is certainly notorious for not looking at the clock before they ring you up. I know that much. I think usually the UK have a little bit more regard, but I don't know if that's your experience. All right, Paul, look, we're just going to pop you back into the waiting room, and we'll introduce our next guest, Carl Gunther. G'day, Carl. How are you going?
I'm well, thanks, Nick. Yourself?
Very well indeed. Thank you very much. You've appeared before, and thank you very much for coming on again today. When I saw the Chapter 11 was coming back into the news, you're the first person that I thought of. back. Obviously, you're the current president of the TMA, and I remember back in 2003, there was a review into complex restructuring. I can't remember the name of the government review, but Chapter 11 was being examined then. So what is it? What's been keeping you busy the last couple of weeks since we last spoke?
Yeah, well, since we last spoke, Nick, and that was actually a few months ago. But most of the work I do is working with CEOs and CFOs, largely around coaching from a restructuring perspective. So nothing as glamorous as Speedcast with Paul, but nonetheless challenging in many respects because of the environment that we're facing. So it's some property companies, some tech companies, and some other companies that were just experiencing pain as a result of COVID.
And safe harbour work, or just advising the boards generally?
Yeah, well, I was doing a little bit of safe harbour work, but a lot of that's come off, obviously, with the moratorium and legislative change. Directors aren't actively looking for specific safe harbour advice. What they are still looking for, though, is restructuring advice. Actually, they recognise that there's going to be some challenges coming ahead, and so they're looking to work out how they respond. And most of the, I guess, the original, how would I say, the initial panic that set in is now settled, but they're looking forward to how they're going to respond when, for example, the moratorium sort of backs off, when the banks start to pull harder, when the ATO starts to be less compliant, and when JobKeeper, of course, when the fiscal stimulus starts to wind back. And so that's what they're very much focusing on, and working out how do they position themselves both for opportunity but also really to survive.
Look, it's a little bit of a game of musical chairs, isn't it? I mean, you just rattle them off there. There's a chair called moratorium. There's a chair called JobKeeper.
Yeah.
And these things are going to get taken away one at a time, and there are people are going to be left with nowhere to sit. I mean, do you have a crystal ball as to? I mean, we're supposedly got moratoriums ending this month. Do you think do you expect the phone to be ringing off the hook come the end of the month, or what's your prediction?
Look, I mean, I guess it's a tale of different sized businesses. I think the moratorium has less of an impact. What I see is in SME land, and anyone can have a view around what constitutes an SME.
Yeah.
Certainly, what's promoting and keeping companies afloat is, I think, more the fiscal stimulus, more the support from lenders, more the support from the ATO. I think those are the things that are making a difference in the big end of town. And I'll call it non-SME, so larger or corporates. I expect that if that moratorium does come off at the end of September, that advice will be sought, formal advice will be sought. I still think there's lots of advice being provided, but it's not in a formal or structured way, particularly in keeping with the legislation as it's currently drafted. And I think what's my crystal ball with government? I mean, we at the TMA have been actively talking to government. We've got a regular slot every Friday, every other Friday with Treasury and dialoguing with them. It's fair to say that they're not giving much away as to how government, as distinct from Treasury, is going to manage the moratorium position. At the TMA, we have a view, and if you've got another hour, I can talk to you on that particular topic. But I appreciate that we've got a more learned gentleman in the form of Paul, who's sitting in the wings there, and he can also, as a fellow board member of the TMA, can provide some input too.
Yeah. Okay. I mean, look, it's interesting that I know that back in the early days, we had a chap on the board that was a senior ANZ banker. And some of our board members were agitating to advocate for Chapter 11, and he said, "Look, if you're going to advocate for Chapter 11, I'm going to have to step down because, in the banks we're not necessarily crash hot on that." But look, we'll just hold that thought. We'll bring Paul back now. I'll just show. There's a few news headlines that have sort of inspired this conversation, and we'll get those up on the screen. So last week we had this US-style Chapter 11 bankruptcy protection bid for business. We had too soft on insolvencies will do more harm than good. In that particular article, the government's considering a number of options to allow debtors even greater flexibility. Insolvent trading relief measures are eventually wound down, as we just said. Mr. Frydenberg, our Treasurer, refused to rule out US-style Chapter 11 changes for failing companies. So, as Carl just said, obviously they're holding their cards pretty close to their chest at the moment. And that other headline there, I was just saying to Carl a bit earlier, it's interesting. That article, I think, when it first appeared, the headline was "Sham Creditors Meeting to Seal Virgin Australia Sale," but it's since been revised to Deloitte textbook demonstration of how to do an admin. And I guess we'll know at the end of today how that Virgin matter has panned out. Okay, so we'll move on to our discussion more generally, and we'll start off with talking about why they're just to sort of pull it back a bit for our non-technical expert viewers and listeners, why it is that we need any kind of legal framework at all. We just have a brief clip to show cut one.
Bankruptcy, Michael, is nature's do-over. It's a fresh start. It's a clean slate.
Like the witness protection program.
Exactly. Not at all.
Okay, I'll go to you first, Paul. Why do we need anything? What's the whole purpose of these Chapter 11 voluntary administration? Just to frame the discussion.
Sure. Well, I mean, I think first of all, it's probably worth sort of assuming there's nothing at all, which there was until sort of the 18th, 19th century when bankruptcy regimes were first introduced. Prior to that point, creditors could simply chase debtors for their debts, and there was sort of nothing to stop them from taking them through the courts, taking all their assets, and eventually putting them into debtors' prisons when they sort of had nothing left to pay. That sort of regime obviously was highly punitive, didn't encourage any kind of turnaround, but also meant that it was a free-for-all. It was whoever got in first was going to get the most, and anyone who was slow-footed would end up with nothing in terms of creditor recoveries. So our basic insolvency regime is about having an ordered way in which when a debtor can't pay all their debts, someone is put in charge to ensure that all the creditors get a fair share, and there's an orderly realisation of debts rather than a mad scramble.
Yeah.
So that sort of explains liquidation and basic bankruptcy. The restructuring regimes we have, so things like voluntary administration, are trying to take the concept a step further and saying, well, we've sort of got the basic fairness sorted out, but simply putting a company into liquidation and selling all the tables and shares is probably not going to get the best return for creditors. The best return is generally going to be for a company maintaining some sort of going concern business, preserving value, and then getting the creditors' recoveries from that process. So the restructuring process is a way of trying to achieve that best value for creditors through hopefully resuscitating the business, maybe not necessarily the company itself, and realising a best return for creditors that way, while obviously at the same time preserving jobs, preserving business, preserving the role in the general sort of community.
Okay. I guess we have this concept of multiple stakeholders. So it's not just the creditors. As you said, there's the shareholders, there's the community, there's the government, of course. They've obviously got their skin in the game with respect to tax, and of course, the market and customers and all that sort of thing. I guess, Carl, all of these regimes, you could say they break into three phases. There's, before, for want of a better word, pre-insolvency events, the actual insolvency event, whether it's voluntary administration or the Chapter 11, and then the post-insolvency event, the deed of company arrangement. Do you just want to just sort of give the 2-minute layperson's guide to what goes on?
Yeah. So the whole pre-insolvency cycle, typically the big question is, do I or don't I put this company through a formal process? And it's clear that in most formal processes, there is a substantial destruction of value, both for creditors and shareholders. And I'll say most. If you do put a company into insolvency, that does happen. So the idea of the pre-bit is to try and assess whether or not you should or shouldn't. And oftentimes, and part of part of where I have particularly sought to play is to try and find ways in a consensual way with stakeholders to try and avoid insolvency and undertake a restructure without a formal process. Obviously, putting a company into insolvency or certainly into voluntary administration, it's an inalienable right of a director under the Corps Act to be able to do that. All they need to do is, with a simple resolution, majority resolution, having formed a view that the company is either insolvent or likely to be insolvent in the future, which is pretty broad. They are empowered and entitled under the Corps Act to put a company into insolvency, into VA, to appoint a voluntary administrator. And that voluntary administrator then effectively assumes control of the company and then seeks to work out what's the best outcome for the company's creditors.
We just sort of keep our head space in that pre-actual appointment stage. I just wonder with Paul, what's deficient in what we're doing in Australia in that pre-phase? Is there anything about Chapter 11 that makes things that pre-process any better, or are we sort of level pegging at this stage?
Yeah. So, I mean, Chapter 11, I would see as sort of broadly the equivalent of administration. So it's a formal process. It's post-appointment, if you like, as opposed to in the pre-phase.
Right. Okay.
In terms of sort of our pre-phase here in Australia, the thing which has caused a lot of, difficulty with restructuring outside a formal process in Australia, the whole time I've practiced really has been the insolvent trading regime and the concern that directors have that if the company is insolvent, unable to pay its debts as and when they fall due, then the directors can potentially be liable for the debts being incurred during that period if the restructuring is unsuccessful and the company ends up in liquidation. And that fear, that risk, has been seen by many as causing a number of companies that don't necessarily need to go to the next stage to file because the directors want that protection.
So we've got safe harbour to sort of take care of that. So have we checked that box when we look at sort of Australian laws versus US laws? Are we checked that box, or are we still a little bit short? Do you think?
I mean, I would say that the Australian regime is still quite a bit harsher on directors than the US regime. There's sort of no equivalent of insolvent trading in that sort of way in the US. There is a sort of a deepening insolvency concept, but it's sort of it's not a significant concern for directors in the same way that that it is here. I think the safe harbour has helped a lot. And it's a very helpful framework for boards generally in terms of thinking about their duties, how to think about their decision-making process through the pre-process. But it's not going to help in all cases. Different boards will take different views on how comfortable they are with that regime. We've now got the temporary regime as well, the COVID sort of temporary safe harbour that goes until the 25th of September, and that gives a very broad brush protection to any debts incurred in the ordinary course of the company's business. And I think that has led to this interesting phase that we're in now, where we've actually got a dip in insolvencies compared to last year same time, despite all the distress we're seeing. So you could say that that issue has been solved to some extent by the temporary regime, but clearly we're going to have another discussion about it come the 25th of September.
Well, I guess Paul hits on something there, Carl. Someone like yourself, for example, if you're going in as a turnaround manager or a CRO or whatever it might be, obviously you want to be protected yourself. You want to be putting all of your family at risk, when you're trying to save a company. And I guess Safe Harbour covers that off to some extent, but maybe we don't have all the protections. So then just to sort of move on to the next phase then, Carl, sort of after the appointment of the administrator, that's the next step.
Yeah, and so look, probably this is where whilst there's some similarities in Chapter 11, the voluntary administration, where the key difference I think here is that under a Chapter 11, once it does go into Chapter 11, effectively the company, the debtor, remains in possession of the running of the company.
In the US,
versus in Australia, when a company goes into voluntary administration, the affairs of the directors that would otherwise be managing the affairs of the company are placed into the hands of the voluntary administrator. So there's quite a distinction and that's kind of where I think the big sort of dialogue and discussion has been emerging here is, do we put a Chapter 11 in and allow the debtor, a la the company, to continue trading and running the company, versus putting in an independent umpire, a voluntary administrator, to deal with the affairs of the company, which may involve trading on or not, as the case may be.
Right.
But in Australia, if I single back to Australia, the key thing then, the company can either be returned to the directors. This is how a VA will take place, or at the ending of a VA, it'll either be returned to a company's directors. And in my lifetime, I haven't ever seen a circumstance where a VA returns the company back to the directors in the formal sense. It's come through another form. It'll either be resurrected through a deed of company arrangement, which means it's an arrangement where there's a compromise, and there are certain rules around how that compromise will take place, or it goes into liquidation. And that's kind of the three parts. I don't know, Paul, have you ever had a circumstance where the VA has just returned the company to the directors?
Well, it's funny you say it, actually. I did deal with a situation about a month ago where the creditors voted to return the company to the directors in a situation where the company was highly insolvent. So the administrator had to adjourn the meeting and go off to seek court orders in terms of what to do.
I have heard of that happening once, a couple of years ago. It was only a small matter. But, the meeting wanted to return the company to the directors. I don't think they understood. They were badly advised and all the rest of it. We do have – I'll just ask you a question in a moment, Paul. We've just got a little cut number 2, the process of declaring bankruptcy in America and how that works.
I declare bankruptcy!
Is it really as easy as that?
Yeah, that's exactly what we did in Speedcast.
So just let me ask you, Paul, the way I understand it, in that sort of what we would call the VA period, what are the upside and what's the downside of having the actual the directors in control instead of an accounting firm?
Yeah, so it's a key sort of philosophical, I think, difference, which there's sort of endless debate, as we've seen in these newspaper articles about whether sort of it is preferable to have management and control or an independent expert. The advantage, I think, of having a debtor in possession system is that you keep management who know the business, who've been running the business, and can keep sort of, to the extent possible, business as normal, running through the process. So I think the argument is you preserve more value that way. There's less disruption by having someone who's, the alternative is you have someone who's effectively a stranger to the business coming in and sort of having to put some degree of freeze on everything while they work out what's going on, what should be done, and then sort of coming up with a plan. So you do have that sort of continuity. You also sort of avoid some of the debate about who's to blame. Our sort of regime, our creditor regime, is very focused on sort of who's to blame. The external administrator comes in, and one of the key duties is to investigate who caused the collapse, their actions available against them. You have that in a debtor possession system as well, but it's not really the focus. The focus is on how you turn around the business.
I guess it's interesting, isn't it? Because of a UK-based system, we, as you said before, the whole notion was if debtor's prison, whereas in America, having a few failures in the past is a badge of honour.
There is a trade-off though with when you have your debtors in possession. The debtor in possession system will typically come with a broad moratorium, so creditors can't take action against the company while you're trying to reorganise. And if you've got the company which is failing, has got a moratorium, you need some sort of oversight and protection for creditors, that they can see what's going on, that value in the estate isn't being sort of needlessly eroded by delay, by a plan that's not going to work. So in the US, the counterpoint you have for the existing management being in control is you have the court, the US Bankruptcy Court, which is a specialist division of the federal courts in America, takes a very involved role in the whole process. So you file your Chapter 11 with the bankruptcy court. You have your first day hearing where you need to get a whole lot of permissions in terms of what you're doing with the business, who you're paying, borrowing money. And then throughout the process, all the key decisions will tend to need to be approved by the bankruptcy court.
Right.
And because it's a court-driven process, there's a lot of lawyers, and ultimately it's quite expensive.
Right. Okay. So, Carl, let me ask you, obviously, I can understand how the Chapter 11 process and the debtor in possession process might work for what we might call large, complex insolvencies. But, Australia is an SME economy. So can this sort of framework, lots of lawyers and lots of going to court, can that work with SMEs?
Well, I don't think it would work on a pure Chapter 11 process in Australia for SMEs, just purely because of the cost. And I think that's a major challenge. But look, I'm going to sort of take a slightly controversial stance, and I've in preparing for this, and I'm not as learned on Chapter 11 as perhaps what Paul is, but I saw a very good quote, and it says that the process repeatedly has been shown to produce too few rehabilitated companies in the long term. It's very expensive, and it takes a long time to administer. Now, that's a quote that was framed out with Chapter 11. It's fair to say you could draw that same conclusion regarding our own insolvency laws, the voluntary administration process. And so what is clear to me is that regardless of whether it's a Chapter 11 or our own process, we do need to consider in the Australian sense, and I think the government needs to consider in a relatively short period of time what we can do in order to assist SMEs. And I don't think just necessarily reverting back to business as usual under the voluntary administration regime is the first choice. It may be the only choice that we take, but it shouldn't be the first choice. We should be looking at other ways in which we can do that. And there are other examples in other jurisdictions which the TMA has been looking at, and in fact Paul and I have been looking at for some time in the form of a CVA. It's not perfect, but there are other ways in which you can look at it.
So what's the CVA? That's the UK model, is it? Or
Yeah.
So
CVA
right.
is a company voluntary arrangement. So essentially, it's a deal between a company and its creditors. It's unsecured creditors, where a plan is put up, typically with some sort of compromise on the debts, in order to return the company to solvency. And it's voted on at a creditors meeting, and if you meet the required threshold, which is 75% by value and I believe the majority by number, then it's passed and is binding on all those creditors. So it's very similar to the deed of company arrangement that Carl mentioned, albeit the deed of company arrangement that we have is only as part and parcel of an administration, whereas the CVA in the UK, you can do standalone. Company doesn't need to file for any sort of administration. There's no external administrator per se. There is someone who sort of supervises the process, but it's a relatively simple process from that regard.
so is that still binding on all the creditors?
That's right. It's binding on all the unsecured creditors. Secured creditors, much like the DOCA in our regime, they can stand to one side.
So it's key. It can happen outside of a formal insolvency process, right? And that's an interesting process because I don't mean to digress on this, Nick, but that's where government is really concerned around SME land and what happens,
Well, there's a couple of issues. One is saving the SME. Another one, of course, is protecting all the creditors. And so then it's all about how the schemes are worked out and how the dockers are worked out. We've just got Cut 3 that's maybe a bad example.
How is this not a pyramid scheme?
The more people that get involved, the more people who are investing, the more money we're all going to make. It's not a pyramid scheme. It's not even a scheme per se.
So we do have, there is an issue of protecting creditors as well. So how do you sort of balance that with these other regimes? On one hand, obviously having a bias for saving the company and getting better outcomes, I guess, versus the risk of these things being exploited.
It's a good question, and there's sort of a couple of lenses I think you can kind of put creditor protection through, and there's sort of, to my mind, there's a couple of key things you need to think about. So firstly, who's really making the decision? You have processes where you have an external administrator of some type who makes the decision, for example, to sell the business, and then to sort of get what they get. Alternatively, you have processes where there is a plan of some type that's put to creditors, and creditors get to vote on it, and it's ultimately their decision. So I think sort of who's making the decision is important, and then ultimately, if it's not the creditors themselves, who are they reporting to? Do they owe duties to the creditors? Secondly, there's the question about information. Do people actually have enough transparency about what's going on? Do they understand the options? Were there alternative deals that might be better? Do they understand the financials of the company and its viability? All of those sorts of things. And certainly sort of in some processes, there are real criticisms around the level of transparency. I think we might talk about pre-packs in a minute, and that's sort of one of the allegations that's been levelled at pre-packs, that you have the problem that A, it's a third party, the administrator, who makes the decision, but B, sort of, it all happens very quickly without the creditors being involved, and they don't really they don't have the transparency as to why that particular deal has been done.
Sorry, the way it's done in Australia or the way it's done in the UK?
I'm talking about the UK pre-pack there. Yeah. Those are the sort of the traditional criticisms of that regime.
In Australia, Nick, pre-packs aren't part of the law. You can't actually enshrine a pre-pack in the law, but it's not to say that people aren't pre-planning and pre-packing insolvencies here.
All right, we've just got a question. Yeah. I'll just flash up on the screen there. For that, maybe I'll throw that one to you, Paul.
Okay, so the question from Deanne is, does the CVA in the UK result in more SMEs surviving? Are there any stats that support it? Look, I don't know specifically, but I would suggest that it's a tool that is useful in some circumstances, but is probably not going to be a silver bullet. Where you tend to see it used in particular in the UK is around retail businesses with a lot of leases, where the company needs to sort of really reset its trading footprint. It needs to close a number of unprofitable stores. It needs to readjust rents on others. It's been used quite heavily in that context. The results have been mixed, I think it's fair to say. Some CVAs have succeeded, others haven't. One of the challenges to making a CVA work well, and one of the things we've been talking to the government about here, is making sure that it's streamlined enough that it can be used in those sort of small SME cases that Carl's talking about. Sort of relatively simple cases where you're putting up a pot of cash, and people are taking a compromise on their debts.
There is one question I want to put to you both. As I said to you a bit earlier, when we were looking at this back in the early 2000s, there was concern from the bankers' point of view. And if you mess with the system too much, and if the banks perceive that you're going to introduce a regime that compromises their ability to recover their loans, then you maybe run into the problem of then banks, being less inclined to lend. So do you think, does Chapter 11 or CVA, how does that affect if you sort of put a banker's hat on? I'll start with you, Carl, and then I'll come to you, Paul.
Yeah, I mean, I think it's a genuine concern from lenders. You don't want to be in a position where their security is compromised, or at least the decisions made regarding their security are in the hands of unsecured creditors or creditors that don't have the same security structure as the lender. So, obviously a very valid concern. But my sense is, certainly within the CVA regime, it's principally around unsecured creditors, taking a view on that. Ultimately, the secured lender can participate in that voting cycle or not, as the case may be, but it's not seeking necessarily to impact the secured lender's position. I'll defer to Paul around the technical aspect of that. And with bankruptcy, of course, there's an additional regime where lenders can advance funds to the company during a bankruptcy, and in fact they then sit as a higher priority against other lenders. And I think that's actually not a bad idea. That has a lot of merit, and so that process should be something that we should be considering. But
you're talking about the DIP funding, the debtor in possession funding. Yeah,
Correct.
yeah. Paul, what are your thoughts?
Every time these sorts of reforms, Chapter 11, things like that, are brought up here, that's one of the concerns about, is it going to cause a dry up in lending? I mean, I think it's worth reminding ourselves that sort of Chapter 11 and CVAs come from America and the UK, which are the two biggest finance markets in the world. People go to those jurisdictions as finance parties to restructure rather than avoid them. So I think it's you know, if it's done properly, it's a good feature both for lenders and for debtors because it's preserving value for everyone. Obviously, if it's done poorly, then it is a real problem. So you know, it's just about making sure we do it right.
Okay, look, we will wrap up there. It has been a technical discussion. I guess we've got into some legal technicalities, but you know, the fact is that this thing is now back in the press. The government's considering these things, and hopefully our viewers and listeners are that much more informed for having heard from us. So, Carl and Paul, thank you very, very much for joining us and for sharing your wisdom and insights. Thank you very much to our listeners, our live viewers, and to our subscribers. And we look forward to speaking with all of you again very soon. Cheers, and thank you very much, guys.
Thank you.
Thanks.